Hi, I'm Elliot Yu, and this is Hull Harbor, located on Nova Scotia's Bay of Fundy. Hull Harbor is known for its extreme tides that lift these boats 50 feet or more. With around 3,680 billion cubic feet of water moving in and out of the bay twice per day, lifting boats in the harbor at the rate of an inch every minute. It's also a pretty good illustration of what happened in energy markets last year. The rising tide of oil prices literally lifted all boats in the sector. The S&P 500 Energy Index soared 27.4%, more than double the S&P 500's 11.7% gain. In fact, the S&P 500 Energy Index was by far the best performing sector in the S&P 500 last year. Even the 10 worst performing stocks in the S&P 500 Energy Index jumped 8.6% in 2016, and only 3 of the 35 stocks in that index showed a negative return. 2 of those actually declined less than 0.5%. Warning, last year's rising tide bull market in energy has resulted in extreme investor complacency. The cozy consensus for 2017 is that the OPEC and non-OPEC accord at the end of 2016 will push oil prices up to $60 or even $70 a barrel this year, powering another rising tide for energy stocks. However, our research confirms the bullish crowd is ignoring some dangerous trends underway in the global oil market. Trends and developments that are just starting to impact global oil markets, resulting in the vicious 9% one-week swoon in crude earlier this month. Before you dismiss me as some sort of a bearish crank, I urge you to watch this short 20-minute video presentation which explains exactly what we're seeing and why it could be so dangerous for energy stocks. Watch this presentation through to the end and then decide if I'm for real or just full of hot air. On November 30th of last year, the Organization of Petroleum Exporting Countries, better known as OPEC, announced a much-anticipated deal to cut their collective output by 1.2 million barrels per day, starting January 1st of this year. Shortly thereafter, OPEC met with leaders of several non-OPEC nations, including, most importantly, Russian Energy Minister Alexander Novak. On December 10th, 2016, these 11 non-OPEC countries, including Russia, agreed to cut their collective output by a further 558,000 barrels a day. That brought the total planned cut to 1.758 million barrels per day, as you see on my slide. However, this deal just isn't all it's cracked up to be. Let me explain. The cut was apportioned between the various OPEC member states. So, for example, OPEC's leading producer, Saudi Arabia, agreed to cut production the most, about 486,000 barrels a day. Kuwait agreed to a 131,000 barrel a day cut. Iraq agreed to a 210,000 barrel a day reduction, and so on. The idea, of course, was to reduce global oil supply and help drain the glut of excess oil inventories and excess production way over world demand that's been pressuring oil prices since the middle of 2014. However, I looked at February production data from all OPEC members, including both numbers reported by these countries' own energy ministries and third-party estimates made by groups analyzing information such as tanker loadings and satellite data. What I found just isn't pretty. In February, it looks like Iraq cheated to the tune of 89,000 barrels a day, meaning that the country produced 89,000 barrels a day more than its quota. Venezuela produced 38,000 barrels a day more than it agreed. And the United Arab Emirates was about 76,000 barrels a day over its quota. In total, OPEC cheating, including the producers I just mentioned, and several smaller OPEC producers who cheated by, in some cases anyway, just a few thousand barrels a day. Total cheating comes to around 270,000 barrels a day. So, let's just remove that from the chart of total OPEC production cuts. And let's move over to the non-OPEC countries that agreed to cut production by 558,000 barrels a day on December 10th in a meeting with key OPEC nations. The biggest non-OPEC supply reduction was supposed to come from Russia, which agreed to reduce output by 300,000 barrels a day gradually over the first quarter of 2017. Well, 2 months into the quarter, and they've reduced output by as little as 120,000 barrels a day, meaning they're outproducing their quota by 180,000 barrels a day. There's some evidence that March output from Russia has fallen further, but we'd be very surprised if their total production cut was much more than 200,000 barrels a day by the end of this month. And to make matters worse, some non-OPEC member states are doing even less to meet the terms of their agreement. Kazakhstan, which agreed to cut by 20,000 barrels a day, has instead increased production, as have Sudan and South Sudan. Listen, the bottom line is that in the best case scenario, non-OPEC compliance is around 2/3, meaning that there's at least another 180,000 barrels a day of cheating going on from that side of the agreement. So let's just remove 180,000 barrels a day from the chart as well. Then let's consider two special cases within OPEC, Nigeria and Libya. While both are OPEC members, both countries have been experiencing severe civil unrest, and they were exempted from OPEC's production quotas announced last November. As of last October, Libya was producing around 520,000 barrels per day. Since then, the country has made some progress toward restoring production as a military commander from the eastern part of the country, Khalifa Haftar, took over the key ports and oil export terminals at Ras Lanuf and Es Sider. Once Haftar reopened the ports, Libyan production ramped up to around 700,000 barrels a day in February, and there was some optimism it could even grow to 1 million barrels a day by next year. After all, as recently as 2012, Libya was producing more than 1.5 million barrels a day. However, a group called the Benghazi Defense Brigade claimed to have seized control of both of those ports on March 3rd, and both ports were subsequently closed, reducing production by around 100,000 barrels a day at least. While Khalifa Haftar is claimed once again to have retaken the ports on March 14th, it's way too early to tell if the security situation will allow recovery in oil volumes in the near term. Look, it's tough to really know what's going on in Libya, so I'm just going to take the most bearish forecast out there and say their production will be down around 20% from that 700,000 barrels a day in February. So that puts us at 560,000 barrels a day, up just 40,000 barrels a day from what they were producing back in October. And that's really conservative, as I suspect that over the next few months, Libya will produce way more than 560,000 barrels a day. Nigeria has been struggling with militant attacks of its own on pipelines through the crucial Niger Delta region for some time. Yet the country does seem to be making some progress on talks with militants and better security. Production is now up 80,000 barrels a day from the October level, right to around 1.68 million barrels a day. I actually see some more upside for Nigerian production, but I won't factor that into this calculation here. Bottom line, Libya and Nigeria combined have chipped in another 120,000 barrels a day. So let's just chop that off the chart, as those have offset some of the November 30th OPEC cuts. And that brings me to the most important adjustment I'm going to make in this video. You see, as oil prices plummeted from the summer of 2014, many in OPEC, including the Saudis, believed that the U.S. shale producers in fields like the Bakken, Eagle Ford, Niobrara, and even the Permian Basin of West Texas just wouldn't be able to make their economics work. So smaller producers would go bankrupt, and the bigger players would dramatically reduce their drilling activity. And that did happen to an extent. The U.S. oil-directed rig count, the number of rigs actively drilling for oil and gas in the U.S., declined from a high of about 1,600 rigs in October 2014 to a low of just 316 rigs at the end of last May. However, oil producers in the U.S. shale fields also use the bear market as an opportunity to dramatically improve their efficiency and to deploy new technologies that dramatically increase the productivity of shale fields. These techniques had the impact of lowering their break-even costs for drilling in the shale. The consensus view within OPEC for much of last year seemed to be that it would take sustained oil prices around $60 a barrel to reignite shale production. So the Saudis and OPEC seemed to believe they could cut output and push prices back up to that level without risking a surge in U.S. shale output that would undermine their production cut agreement. In short, I believe the evidence is now overwhelming that OPEC and the Saudis were absolutely wrong about that. The U.S. oil-directed rig count, once again, it's just the total number of rigs drilling for oil in the U.S., bottomed out in May when oil prices were still in the 40s. And back in August and September, when a potential production cut deal out of OPEC first began to leak into the press, the oil-directed rig count really began to accelerate, jumping 150 rigs, a little over 40%, between August and the end of last year. And just remember, U.S. producers dramatically increased their oil drilling activity, even though the average price of oil between the end of May and the November 30th OPEC deal announcement was just about $46.50 a barrel. It takes 3 to 6 months for a new oil rig to add significantly to U.S. production. So a rise in the U.S. rig count that started in May didn't impact supply immediately. However, by October of last year, U.S. oil production began to rise rapidly, and according to data from the Department of Energy's Energy Information Administration, U.S. oil production is up an incredible 566,000 barrels a day just since last October. That's right, and let me underline this fact. U.S. oil production is currently rising at a pace of more than 100,000 barrels a day every single month. As I've said, the reference month OPEC is using to measure its production cuts is October 2016. So let's use the same month for the U.S. Since U.S. production is up 566,000 barrels a day, using that same base month, I'm going to move that off my chart here. There is one offset to all this, and that's Saudi Arabia. OPEC's largest oil producer likely knew, even as they inked their production cut deal last year, that other OPEC members would cheat on the agreement to at least some extent. So the Saudis actually cut more, way more than they agreed on November 30th to offset that cheating. While the Saudis indicated this week that they produced a little over 10 million barrels per day last month, only slightly under their quota of 10.058 million, the kingdom said a significant amount of this oil was simply placed into storage only for domestic use, not for exports. Adjusting for that, most sources peg Saudi production at around 9.78 million barrels a day last month, which is roughly 280,000 barrels a day more than they agreed to cut. Since that's offsetting some of the cheating going on within the other OPEC members, we need to add that back to the chart. So there you have it. That massive 1.758 million barrel a day cut that pushed oil prices well over $50 from December through early March of this year is actually a roughly 900,000 barrel a day cut when you adjust for cheating and fast rising U.S. oil production. And I must warn you, the truth is that the picture is even worse than that. You see, since October, U.S. oil production has been growing, as I said, at a pace of around 100,000 barrels a day every single month. That means that by June, when the current OPEC production deal is set to expire, U.S. oil production could be up an additional 300,000 barrels a day or more. In addition, Saudi Arabia's powerful oil minister, Khalid Al-Falih, speaking at the CERAWeek conference in Houston last week, said that Saudi Arabia was willing to shoulder a large portion of the production cut agreement in the early stages by cutting more than it agreed. However, he said, and I quote, "The kingdom won't indefinitely bear the burden of free riders." In fact, we believe the Saudis may want the price of oil to fall further in the short run to help slow the growth of U.S. shale oil production this year and punish OPEC members and non-OPEC members like Russia who continue to cheat on their quotas. However, regardless of Saudi policy, we see another factor that's likely to push oil back to the $40 a barrel level in the short run. Let me explain that on our next slide. Every week, the CFTC, the Commodity Futures Trading Commission in the US, and the ICE Exchange in the UK release a report called the Commitment of Traders Report, which summarizes the futures market positions of different types of traders, including, most importantly, hedge funds. We get data from the US WTI futures market, the West Texas Intermediate Futures Market, on Friday afternoon, and we get it for the London traded Brent contract for oil on Monday. It's extremely important to watch how hedge funds are positioned. This first chart shows the net length of hedge funds in both the WTI and Brent futures contracts. In other words, this shows how many contracts worth of both Brent and WTI crude oil futures hedge funds have purchased. The key point to understand is that this is what we call a contrary indicator. In other words, when hedge funds are aggressively betting on a big rally in oil prices, that tends to be a short-term sell indicator for crude oil prices. So let me just show you a couple of examples of how this works. Do you see how in March of 2015, which I just highlighted, hedge funds were long about 550 million barrels of crude? And this was an aggressive move because around a month earlier, they were only long around 325 million barrels. The hedge fund position didn't just trend higher over time, but jumped up quickly, a sort of spike higher. Well, this is a classic sell signal for oil. On the 5th of May in 2015, just as those hedge funds were reaching an extreme betting on higher oil prices, WTI was trading around $60.40 a barrel, and Brent was up around $67.50 a barrel. This was close to the top in both of these markets. And check this out. By early August of the same year, which I just highlighted in green, hedge funds had reduced their bets on oil to just 225 million barrels or so. And WTI and Brent were trading at $43 a barrel and $49 a barrel respectively, down about 28% in both cases. I know this all seems a little counterintuitive because you might think that heavy hedge fund speculation in oil would be a good thing that actually pushes the price of oil higher. However, here's the problem with that line of reasoning. Hedge funds aren't usually long-term investors. They're hot money, willing to jump in and out of markets to turn a profit. Back in May and June of 2015, oil prices stopped rallying and traded sideways for a time. While there were plenty of pundits on Wall Street who tried to call the bottom in oil prematurely in the spring of 2015, there were also plenty of bearish fundamentals, including still bloated oil inventories and, of course, excess supply from both OPEC and non-OPEC nations. As it became clear that the market wasn't going to shoot back to 70 or 80 bucks a barrel, and once it became clear that there was risk that the market was oversupplied and could see a sharp sell-off, some of those funds began to sell out of their positions. That put pressure on oil prices, which in turn prompted other funds to sell out of their long positions to control their own losses. This self-reinforcing sort of vicious cycle is what we call a hedge fund liquidation cycle. So I won't belabor the point, but the same thing happened last year when hedge funds got extremely bullish in May and caught on the wrong side of the trade when oil flatlined again. In the end, hedge funds liquidated their long positions and the price of oil fell around 18% over this time frame between May and August 2016. So that brings me to the proverbial elephant in the room, which is the massive long position hedge funds have in oil right now. The total long position in both WTI and Brent reached 922 million barrels of oil at the end of February and has declined only modestly to around 850 million barrels today. Suffice it to say that this is actually a record net long position. Even during the bull market years back from 2012 through 2014, we didn't see hedge funds this bullish on oil. And more importantly, you can really see just how much they've ramped up their positions since the OPEC meeting at the end of November. Brent and WTI oil traders have bought 350 million barrels of oil since November 29th. If that's not a spike, I just don't know what is. So let's take a look at WTI specifically. In this market, this is the US oil benchmark, the hedgies have bought around 190 million barrels of oil just since the end of November alone when OPEC announced their production cuts. The important point to note is that a good amount of that oil was purchased after the OPEC meeting when prices climbed to that $50 to $55 a barrel range. That means they're now losing money. In other words, many of these hedge funds bought oil looking for a pop to $60 a barrel or higher. Instead, oil traded in a tight range for a while and has since broken down below 50. So again, they're losing money, a lot of money. In fact, earlier this week, there was an article in the Wall Street Journal saying that one of the most famous hedge fund managers focused on energy, Pierre Ondurand, lost around $130 million in his funds in the first 2 months of 2017 alone. Now put yourself in one of these hedge fund shoes. Based on the fundamentals about oil and OPEC I discussed earlier, it doesn't seem very likely oil is going to break higher and head to 60. not with U.S. shale oil output growing at 100,000 barrels a day every month, and not with several OPEC and non-OPEC members cheating on their quotas and relying on the Saudis to bail them out. And these hedge fund managers can see just how crowded the long trade in oil is. As I showed you on the last slide, when this trade gets crowded and when funds are heavily net long, it tends to mark a top for crude. There's a temptation to sell out of their oil futures to stem the bleeding. Bottom line, we believe the oil market is in for another liquidation cycle, much like I showed you on the prior slide, a fund-driven sell-off that pushes oil back to the $40 a barrel range. So here's another way to look at the same data that I have found even more useful over the years. To calculate this chart, I simply divide the total position held by hedge funds betting on oil to rise by the total gross short position, which is bets by hedge funds on the price of oil to fall. As you can see, in 2014, when oil was still trading around $100 a barrel, it wasn't uncommon for hedge funds to be long 15 or more times as many oil contracts as they were short. This is normal at the end of a bull market for the funds to get very, very bullish on a market. And after the big sell-off in oil started in late 2014 through late 2016, the ratio generally ranged from around 1 up to around 5 or 6 or so. Spikes to the top of that range, let's call it 4 to 6 times, told us to sell oil. This indicator clearly shows, for example, good sell signals in May, June of 2015, and again in May, June of last year. These are the sell-offs I just highlighted on an earlier slide. Also note that when hedge funds get too bullish and start to liquidate their positions, the selling doesn't abate until this ratio drops back down to 1 to 2 times, which, as I said, is the low end of the range. Currently, hedge fund longs are 8.7 times the short position. That's down slightly from a ratio over 10 at the end of February, but it's the first such reading we've seen at this level since 2014. Listen, I don't know if we're going to see this ratio fall all the way back to 2 or even 3 times. After all, the oil market is healing, and the glut of oil globally isn't as severe as it was in early 2016 on some measures. But I do think we'll at least see this ratio get down to 4 or 5. That's the high end of the prior range. And that spells more selling in crude oil. So what are the conclusions from all of this? First up, OPEC and non-OPEC cuts, as I explained, are smaller than advertised. The reason being some OPEC members are cheating on their agreement. Some non-OPEC members that agreed to cut production, like Russia, are also cheating on their agreement. Plus, we have growth from Libya, Nigeria, U.S. shale, and other non-OPEC producers. The ability of U.S. shale oil production to grow at oil prices around $50 a barrel has complicated matters for OPEC. If they push prices too far above 50, up to $55 or $60 a barrel, U.S. shale oil production is going to accelerate very rapidly and quickly overwhelm the market and send oil prices back down, overwhelm the market with supply. Much of the post-OPEC rally in crude was driven by speculators who are now losing money on those trades. I believe a final whoosh lower in oil is coming, and I think that's going to take us down to the low end of that range, down to around $40 a barrel. We also believe it will be very difficult for oil prices to take out their 2017 highs around $55 a barrel for the foreseeable future. As I explained, above $55 a barrel, you see more U.S. shale oil production, and you see an even higher temptation for some of these OPEC countries and also non-OPEC producers like Russia to cheat a little bit and produce a little bit more than their quota, a little bit more than their agreement, and earn a little bit of incremental revenue. However, we do believe that OPEC will defend the $40 a barrel level aggressively. Should prices get back down there, you're going to hear a lot of jawboning out of OPEC. You're going to hear them talking about extending their production cuts, maybe even cutting a little bit more. They don't want the price of oil to fall back down to its 2016 lows. We think they'll defend that $40 a barrel level pretty aggressively. So what does this mean for you as an investor in energy stocks? It doesn't mean that no stocks are good to buy. It does mean that some stocks that need $60 or $70 oil prices, are very dangerous right now. But we're finding plenty to buy, plenty of companies to buy, which can make money with prices averaging around $50 a barrel, $45 to $50 a barrel. So there you have it. Simply put, Saudi Arabia is caught between the proverbial rock and the hard place. If they refuse to extend the recent OPEC production deal, the resulting surge in supply could quickly overwhelm global markets and send oil prices plummeting back to $30 a barrel or lower. At the CERAWeek conference earlier this month, Iraq even pledged to boost its oil production to 5 million barrels per day by the end of this year. That's up 500,000 barrels per day from the current level. Yet if the Saudis maintain production cuts or cut their output even deeper in the second half of this year, they're effectively funding a massive boom in American shale production. Plus, they'll be providing a tempting incentive for smaller OPEC nations to cheat on their output quotas and take advantage of those higher prices. In short, Saudi Arabia wants to find a Goldilocks price that's neither too high to kick off Shale Boom 2.0, nor too low to crush their own finances. Well, my colleague Roger Conrad and I have spent the last 12 months and literally hundreds of thousands of dollars studying just this issue. And that Goldilocks price isn't $60 a barrel, and it's probably not even $55 per barrel. After all, an average price of a little under $50 a barrel in the second half of last year was enough to push up U.S. oil production by more than 500,000 barrels per day. Just think what these innovative and efficient U.S. oil producers could do with $60 barrel oil. Look, we're not looking for oil prices to collapse back to their 2016 lows. However, moves to the $40 or $45 barrel range are likely over the next few months, as the Saudis and the rest of OPEC try to find a sustainable price for oil that slows the rapid pace of U.S. oil production growth. And as the shocking, near-record bullish hedge fund position in WTI and Brent futures markets is liquidated to more normal levels. However, what's really important isn't just what's going on in global oil markets, but what you can do about it. Well, we've done a ton of research on that and have identified 5 surprisingly simple steps you can take right away to both protect what you've already got in your portfolio and potentially take advantage of these trends to make some serious cash from the volatility in global oil markets. Profit step number 1. First, do no harm. Listen, the first step you must take to protect your portfolio is to sell any dangerous stocks you may hold. There are 2 main categories of energy stocks that we believe to be particularly dangerous right now. First, there are growth-oriented stocks that rallied in the rising tide bull market last year, but they're going to struggle to maintain their current valuations unless oil can rally to $60 or $70 a barrel this year. Unfortunately, due to their strong performance last year, these dangerous stocks also happen to be among the most widely held and recommended names in the energy patch. For example, most large-scale deepwater oil drilling projects require $70 a barrel or higher oil prices to make sense, while shale plays and tieback deepwater projects can be profitable in the 40s. So oil producers are shifting spending in favor of cheaper, small-scale deepwater projects and, of course, onshore U.S. shale fields. That's terrible news for 3 energy names we've identified that sell equipment and services aimed squarely at that large-scale deepwater oil market. All 3 names are among the most widely held and recommended names in the energy patch. Yet we see at least 30 to 50% of additional downside by this summer alone as it becomes clear $60 barrel oil isn't happening this year. The second category of stock that we're recommending you avoid right now is even more dangerous. I'm talking about some of the largest master limited partnerships, or MLPs, a group of high-yield income stocks most investors regard as extremely safe investments. We've identified 5 MLPs, including 2 of the most commonly held names, that are in trouble this year and particularly vulnerable to significant distribution or dividend cuts that could destroy the stocks. Warning, if you own MLPs through an exchange-traded fund or ETF focused on the group, you may own both of these dangerous MLPs without even knowing it, as they're among the largest MLPs in our entire coverage universe. Both of these MLPs are struggling to maintain their current distribution payouts due to excess debt and exposure to uneconomic oil and gas fields in the U.S. that need much higher prices to be viable. Even worse, with one of these two dangerous MLPs already down 30% this year. I'm starting to see some pundits recommending it as a good value buy. You must sell these dangerous MLPs right away before they slash their distributions and see further declines of 20 to 40% this year. Listen, I don't have time in this short video to go through all the MLPs and energy names we think are vulnerable to serious declines and dividend cuts this year. However, I'd like to send you a copy of our Energy Investment Blacklist 2017, including details on a dozen of the most dangerous stocks and MLPs we cover, with absolutely no risk or obligation. I urge you to read our investment blacklist right away before you buy a single share of any energy-related companies, and please make sure you don't hold any of these disasters in your portfolio. We're convinced this blacklist report could save you considerable pain investing in the energy patch this year, and I'll show you how to reserve your risk-free copy of Energy Investment Blacklist 2017 in just a minute. However, first, that brings me to this, profit step number 2, the richest oil field on Earth. Look, ExxonMobil is a $340 billion company. If Exxon were a country, it would be the 27th largest in the world, ranking ahead of Norway, Ireland, Venezuela, Denmark, and Malaysia, and just behind Austria and Thailand. The company's former CEO, Rex Tillerson, is now the Secretary of State for the United States. In short, ExxonMobil is a large and extremely influential player, and what the company decides to invest in has vast and powerful implications for the rest of the industry. That's why the firm's annual Analyst Day meetings, where management discusses their outlook and capital spending plans, are so widely watched throughout the industry. Listen, earlier this month at this year's Exxon Analyst Day, many were shocked by what management had to say. You see, after years of spending most of their capital on big projects outside of North America, Exxon has made a huge bet on U.S. shale. Over the 2018 to 2020 period, for example, Exxon plans to spend half of its drilling and well completion budget in its short cycle businesses, primarily consisting of U.S. shale fields. And Exxon's total planned capital spending budget over that same time frame is $70 to $80 billion. Now that's some serious cash. The reason Exxon is planning to invest so much in U.S. shale is because the returns there are so much better than virtually any other asset in the energy giant's portfolio. In fact, Exxon believes that around 2/3 of their U.S. shale portfolio generates positive returns even with oil prices at just $40 a barrel. And Exxon's largest shale play in the U.S. is the Permian Basin of West Texas and New Mexico, a region where the firm just spent $6.6 billion in January on an acquisition that will add 227,000 net acres in one of the most exciting hotspots in the Permian Basin today. Listen, I'm not telling you to run out and buy Exxon. In fact, I believe Exxon is behind the curve on this shift, and there are much better stocks to buy. However, just remember that a decade ago, the Permian Basin was viewed as a mature oil field with limited upside potential. Yet today, it's beating out projects all over the world, Africa, South America, Russia, and even the Middle East, in terms of total returns on investment and production growth potential. The U.S. Geological Survey recently estimated that the Wolfcamp Formation in the Midland Basin contains over 30 billion barrels of oil and 16 trillion cubic feet of associated natural gas. And that's just one of the dozens of productive oil-bearing layers, and just one small play within the much larger Permian Basin. Some compare the Permian Basin to a piece of tiramisu. The region contains multiple stacked layers of productive rock. Those layers are extremely prolific producers using modern drilling technologies. Listen, investing in the Permian isn't as simple as finding a stock with acreage in this field and hitting the buy button. You see, while there is oil and gas located all over this region of Texas and New Mexico, there are some very well-defined hotspots where producers are seeing the strongest returns. Plus, some companies in the region have solid infrastructure. By that I mean pipelines, gas processing facilities, and storage terminals, while other new entrants are struggling to grow their footprint. And all of these fundamentals are shifting on a nearly constant basis. So to maximize returns, you need to understand the latest well results and the latest technologies being deployed in this region. That's why my colleague Roger Conrad and I are headed to Fort Worth, Texas on April 3rd to attend one of the largest energy conferences in the U.S. focused on the Permian Basin of Texas and New Mexico, the Doug Permian Conference. Speakers include senior management for producers of all sizes with acreage in the Permian, high-yield MLPs that own pipelines and other midstream assets in the region, geologists, state and federal regulators, and technology, equipment, and services firms. For the past few weeks, Roger and I have been putting together a comprehensive plan and a bank of questions we plan to ask at the conference. We'll do whatever it takes to identify the best place stocks to buy for both income and growth in what many believe to be the richest oil field in the world. And on Monday, April 10th, after the conference ends and we have time to compare our notes, Roger and I will deliver our top recommendations, pans, advice, and takeaways from the conference as part of a special 2-hour video strategy session. Simply put, it's one of the most important events of the year for energy and MLP investors, and I want to make sure your name is on the list of attendees. Even better, just for watching this video today and exclusively through this website, I'm offering guaranteed access to this Permian strategy session with absolutely no risk or obligation. However, attendance is strictly limited at this online event, so I'll be telling you how to reserve and guarantee your risk-free seat at the virtual table in just a few moments. However, before we get into all of that, profit step number 3, Fed-proof your income. When the U.S. Federal Reserve began hiking interest rates in December 2015, I just knew I'd start hearing this old and costly investment myth spouted left and right by pundits all over the financial media. Now, after a total of 3 rate hikes, I hear this almost every single day. Here's the myth. Income stocks always underperform when the Fed is hiking interest rates and government bond yields are on the rise. What a load of absolute rubbish. That's not even close to the truth. Listen, my colleague Roger and I have studied Fed rate hike cycles over several decades, and we've identified a handful of characteristics shared by dividend-paying stocks that have actually dramatically outperformed the broader market when the Fed hikes. The most important is dividend growth. You see, stocks that pay a flat dividend over time tend to behave like bonds. And fixed income investments like bonds tend to decline in value when prevailing interest rates rise. So when the Fed is hiking rates, you must look for stocks that have the potential to boost their dividend payout over time. Simply put, stocks with a rising dividend over time tend to actually attract investment dollars when rates are on the rise. Listen, Roger and I spent countless hours combing through our coverage universe to identify MLPs with high yields that we believe will be among the top performers this year, regardless of what the Fed does. We've assembled all you need to know about all 3 MLPs in a hot-off-the-press special report entitled 3 Fed-Proof MLPs with Big Yields. One of our favorite MLPs currently yields 8.7%, has the support of one of America's largest energy firms, and has exposure to both the Permian Basin of Texas and the red-hot Stack and Scoop fields of Oklahoma. A second top MLP pick offers a yield of 5.7% and has completely shrugged off weakness in energy markets and rising rates this year to jump as much as 8%. I want to send you a copy of our brand new report, 3 Fed-Proof MLPs with Big Yields. I'll show you how to request your risk-free copy in just a minute. However, first I promise to tell you, profit step number 4, focus on cost. When oil prices were around $100 a barrel, most Wall Street analysts and investors were focused on production growth and various measures of present value. In other words, they were looking for firms that could develop their acreage fast. Few paid attention to the fact that most oil and gas producers were borrowing heavily and spending way beyond their cash flow in an effort to monetize their reserves quickly and please Wall Street. Nor did many see that some companies, particularly new firms that raised large sums by going public, were vastly overpaying for acreage in some shale fields. Just like the late 90s tech bubble, investing in energy stocks was all about growth at any price back in the 2011 to 2014 era. However, in the wake of the vicious oil bear market that saw crude drop from over $100 a barrel to the mid-20s in barely 18 months, those growth at any price stocks are struggling. Some of the high flyers have gone bankrupt, while others have been forced to sell off their assets to stay afloat, while investors watch their stocks plummet. Today, there's only one metric that really matters: cost per barrel. Producers that can drill new wells that are profitable at $40 a barrel will thrive over the next few years with oil trading in a $40 to $60 range. Firms with access to the lowest cost shale fields will generate enough free cash flow to drill wells and grow their production without borrowing heavily or doing dilutive secondary issues of stock to fund growth. Even better, the low-cost operators are now in a position to buy up acreage from those struggling, broken growth stocks of the boom years for pennies on the dollar. The list includes a small oil producer that's identified a series of hotspots within the larger Bakken shale field of North Dakota and has been driving down costs using new well drilling and completion technologies. Most on Wall Street still believe the Bakken shale is a high-cost play and haven't recognized this company's superior economics. We believe the stock could be up 50 to even 100% over the next 12 to 18 months. Another firm we recommend has a close relationship with one of the best managed independent oil producers in the U.S., which has acreage in the low-cost Permian Basin of Texas and New Mexico, as well as the Niobrara Shale in Colorado. With a near 6% yield and growing its payout at 15% annualized over the past 5 years, this MLP will thrive regardless of where oil is trading or how many times the Fed hikes rates this year. I'd like to rush you a PDF copy of this report right away. So please keep watching, and I'll tell you how you can get your copy risk-free today. And that brings me to this, profit step number 5. Move to the front of the line. Normally, I would never offer this. It's something I usually open up only to a handful of customers on my VIP list. However, I think these opportunities are so timely, and the information is so crucial to your portfolio's health, I just can't keep it under wraps any longer. Listen, I'd like to sign you up for a free beta test trial of our brand new service, Deep Dive Investing. In this service, Roger and I offer a detailed deep dive analysis of sectors and stocks that represent our most timely buy and sell ideas, both in and out of the energy industry. Accept my offer for a free trial today, and I'll send you our first 2 issues of the service. The first is Roger's detailed analysis of the natural gas pipeline industry, with a particular focus on likely changes under the new Trump administration. In this 80-minute presentation and 65-slide presentation deck, Roger identifies the key risks and growth drivers for the group, as well as his top 3 picks to buy right now. In the second issue, I analyze a sector that's benefiting directly from 2 powerful trends: rising interest rates and easier regulation under President Trump. That sector, the regional banks. In it, I'll explain how some banks get an immediate boost to their profits every single time the Fed hikes, while others must wait months or even years to see any benefit whatsoever. And I'll cover the 2 key appointments President Trump is set to make over the next few months that will dramatically change the fortunes of certain parts of the banking industry without any major financial reform package passing Congress. This detailed presentation includes 5 recommendations in the group, including the Connecticut-based bank you've probably never heard of, that's the market leader in a business that's grown by nearly 50% just over the past 2 years alone. This bank is a buy without any change out of Washington. However, we believe it could also receive a game-changing boost from some healthcare reform measures that pass Congress over the next few years. Or how about a California-based bank that sees an immediate boost to the interest received on 90% of its loans every time the Fed hikes rates? Located in the heart of Silicon Valley, this bank is a key player in the venture capital and private equity industries. I'll also cover a quality Texas business bank, a turnaround story in Florida, and a fast-growing bank in America's heartland. I'm looking for gains of 30 to 50% in these banks this year, and I'd like to get you in on our deep dive VIP free trial list today and send you all of our most timely recommendations right away. The best part is, you can take a look at my research and receive everything I've mentioned, including all 5 of the premium bonus reports and strategy sessions I've mentioned today, with absolutely no risk or obligation. That includes our detailed strategy session report from the Doug Permian Conference in Texas, due to be released on April 10th, and an exclusive VIP free trial to our deep dive investing service. You'll have all the information you need to profit from the energy sector this year, and you'll know which stocks you must sell right away to preserve your wealth. Simply click the green subscribe now button below this presentation and test our Energy and Income Advisor service for 30 days. Download our special reports and we'll register you for our April 10th strategy session covering the Doug Permian Conference. Read 2 detailed monthly issues of Energy and Income Advisor. Gain exclusive access to our model energy portfolios, offering suggested allocations for growth, income, aggressive, and conservative investors. And read through our extensive archives. Now let me ask you a simple question. Wouldn't it be great to be able to pose any question you like about the stock market, the economy, or individual stocks and bonds, and have your questions answered in real time? Let me tell you about our monthly web chats, a feature of our service Roger and I pioneered a decade ago. It's still the most popular feature of the Energy and Income Advisor service. These chats are an opportunity for you to ask us any question you wish about stocks or recommendations, the economy, or the broader market. Ask any question you like, and we'll answer every question we're asked on the chat. Last month, we were online for more than 5 hours answering questions posed by our subscribers. Our next scheduled online chat is coming up in just a few days. Just enough time for you to read our research and prepare any questions you have. Click the green subscribe now button, sign up for a risk-free trial subscription to Energy and Income Advisor, and we'll rush you the details of how to log on to our exclusive subscriber-only online chat. We believe there's no better service on the market today, and all we're asking is that you give us a fair try and see for yourself. If you don't believe it's worth every dime of the subscription price, cancel in the first 30 days to receive a full refund, no questions asked. And for viewers today, we're offering Energy and Income Advisor at our special introductory price. What have you got to lose? Test our service for 30 days. Read all of our research. Join us on our April 10th Permian Basin Strategy Session and join our monthly web chat. Then decide. If Energy and Income Advisor isn't for you, cancel in the first 30 days, keep our exclusive reports and presentations, and I'll refund every dollar of your subscription price. No questions asked and no hard feelings. Here's to your wealth. To start your risk-free trial, please click the subscribe now button below this video and join us today.